S&P 500 has rallied over 250 points for 5 weeks of gains. Bob, what happened from the February 11th low where everybody was selling, now everybody wants to buy?
It's been an amazing run, hasn't it,
yes,
Jill?
It
and I think when we look at the divergence between interest rates and the stock market, we can kind of get a feel as to why this turned. And what we talked about earlier was that when interest rates get to a certain level on the low side, I think it went to about 1.5% on the 10-year yield, hedge fund managers, big fund money managers decide that they're not going to get as good a return on fixed income as they would on equities. So we see a light, it's almost like a light switch goes off, right? You hit the light switch and we all of a sudden go from risk off to risk on. And I think that's what happened. We've had these sort of rallies happen 3 times in the last year and a half. October 2014, we ripped 220 handles on the upside on the S&P 500. We ripped over 200 points on the S&P 500 last October. When we bottomed in September, it looked like we were going to be heading down to death. So that's the sort of thing that we get a shift from risk off to risk on.
Now, you brought up low interest rates. It's been interesting because with this 5-week rally, the financials really participated because we did not see that for the end of 2015, the beginning of 2016. Now, for banks to grow and increase their earnings, they need higher interest rates. Why do you think they're performing this well in an environment that is negative for them?
Well, I think that's just one component of the earnings for banks. You talk about net interest margin, or NIM, which is the difference between what they're paying and what they're borrowing at. So yes, that works very well for banks when the yield curve is steep. We don't have a real steep yield curve right now. We have Fed funds rate essentially at 0. Well, it's a quarter basis point, right? And we have long-term rates at 1.5% to 3% where they were. Now they're stepped up a little bit to 2.5% to 3.5%. That's still not a very big margin between what they're borrowing at and what they're paying. So I think that if that yield curve starts to steepen, the only way you're going to do that is if you get A, more inflation, or B, more growth in the economy.
Right. And finally, are you buying here? Do you think it's time to step back a bit, or are you observing market action at this point?
Well, I'm a trend guy, so I like to try. I don't like to try to find the tops. I don't try to find the bottoms. But I do, to a man, believe that this rally is probably gone a little bit too far. So to answer your question, I'm not adding a lot of new stuff. I'm being very selective. I'm just trying to find the right stuff that's going to play for me. I'm taking profits as I've been moving along. And look, you know what? There's the way this market reacts. We're going to have some big whacks coming in from the market. So it just happens. And I don't really want to be there. Give back some of the gains that we've had over the past few weeks.
Okay. Thank you very much, Bob.
Thank you, Jill.